So essentially we've got three categories of gold miners. We've got the majors. They produce over 1 million ounces per annum of production. There's 5 international majors that operate in Australia, and they have other operations around the world. There's none listed on the SGX. We have the mid-tier producers. They produce between 200,000 ounces and 1 million ounces per annum. There's less than 10 mid-tiers listed on the, that operate on in Australia. None of them listed on the SGX. With the juniors, these produce less than 200,000 a year. There's 10 companies, junior companies operate in Australia, and the SGX has its own junior gold mining company, CNMC Gold Mine Holdings, and they're producing just over 26,000 ounces a year from the Sokar deposit in Malaysia. And there's a number of mining companies that have resources that aren't yet in production, and one such example on the SGX is Wilton Resources. They've got the CMS project in West Java, and there's, for your information, there's just a copy of the recent resource and reserve statements.
Jeff and Alan, about the three categories of the gold miners. You distinguished between what the levels are and what the considerations are. But why should we as investors care? If the company is making enough money, and as you say, a small company can actually have a very good deposit, a large company can have a very poor quality deposit. Does it matter whether we go for the majors, the mid-tier, or the juniors?
I think that comes down as to the level of investor you are and your risk profile you're willing to take. If you like blue chip stocks and you always want a dividend, then the majors are for you. However, if you like the excitement of a junior company that in Dore's example, sorry, Andy Wells' example, that went from a 20-cent float, tripled in the first month, and then went to $1.51 in 7 months. I think everyone in the room would take that. So it just comes down to the risk tolerance, I guess, because let's face it, there's a lot of companies out there that started drilling at the same time that they drilled Andy Well. They didn't get the same results as that. So that's where it's trying to identify those companies that do have a quality project that could potentially turn into a mine.
But you see, that was the point. You were saying earlier, not all of these ore bodies are created equal. And if a small company can have a very good ore deposit, isn't that as good as a blue chip, even though it's a smaller company?
It is in that case, yes. But
what I've just heard you say is that it actually doesn't matter whether a mid-tier, a junior, or one of the majors. What matters is the quality of the deposit. Is that a fair way of looking at it?
That is a fair point as well, yeah. The deposit, you need a deposit that can weather commodity cycles as well. So if you're a marginal producer with a very low-grade deposit and a high strip ratio, there's not a lot you can do when the gold price goes down, unless you're hedged, as we spoke about earlier. And that comes back to the reason why companies do hedge, to protect themselves against scenarios like that.
Say if you start off with a junior miner that has an average or low quality ore body, how much capex investment does it take to actually develop the mine, enhance the quality of the mine? For instance, extending the mine's life, improving the strip ratios and so on.
Like I showed with that share graph, everything, the value comes from discovery. If they find more resources that they can convert to reserves, then that's where they're going to get their growth and extend their mine life. There's a lot of other things that can go into it. Improving grade, the ore body has to be able to handle an improvement in grade. If it's, I was talking about those very low grade deposits that it's half a gram material, there isn't much scope to improve the grade up on that. But if you've got an ore body that is, say, 4 meters wide and it is, say, 4 grams per tonne, if you narrow it to 2 meters wide, potentially you might be able to get 8 grams per tonne. Then you can mine it in more of a narrow underground method or open pit with smaller machinery, and therefore you can increase your revenue. You won't have as many tonnes, so you'll reduce the mine life, but you'll increase your revenue. Therefore, that will give you more money to explore and extend, hopefully, the mine at depth. And it's a good question because a lot of initial resources that are announced for companies, they never stay the same. They always grow. A company will say, we've got a 3-year mine life and we're going to mine X amount of tonnes and ounces. And a few years later, it's often, we've found this discovery, we've increased it, I've worked at mines where the mine life just kept on getting extended and extended. The super pit that I put up there is due for completion in 2021. I remember doing a mine tour there when they said the pit was going to finish in 2017. So it's already 4 years on now in a very mature area. So as we get closer to 2021, will it be 2025? Probably.